This episode of Talk Your Book is proudly brought to you by Honan, providing a complete range of insurance, risk and financial solutions.
Yeah. Fundies called me up, told me to take a look, but stay stubborn as bulls and talk their own book. Get the money, get the money, get the money.
Hi, I'm Chris Judd. Welcome to Talk Your Book. Today we'll be joined by Romano Sala Tenna from Katana Asset Management. And Romano, I needed a big name for the first ever episode in partnership with Ticker News, and you've delivered, so thanks very much for making the time.
Thanks for having us on, Chris.
I thought before we get into your stock pick, if you could just start with a little bit about Katana Asset Management and how you guys look to invest.
Yeah, so we're style agnostic, which means we try and take the best precepts across the 5 investment styles as we see them. Value, growth, quality, fundamental and momentum, and try and employ those precepts. We try and reduce any artificial constraints that limit how we think or how we invest. And we've been going for 17 years now, which is quite unusual in the Australian landscape. And last week, we're actually fortunate enough in Sydney to receive a Star Manager Award as one of the top 10 managers in Australia out of about 10,000 that they crunched the data on. So we've just got to try and take that and continue to develop and evolve.
Well, congratulations on the award, and maybe tell us a little bit about your cash positioning at the minute, because I think that probably tells a story on how you're seeing markets.
Typically try and sit at between 15 and 35% cash through the cycle. Our mandate allows us to go to 80%, but it's unlikely we'd ever get anywhere near that. Right at the moment, we're sitting on 38%, which probably explains how we're currently positioned. We see a record number of issues that can potentially derail these markets and bring us lower, and they're well documented: the property crisis in China, quantitative tightening, which is now US $95 billion a month, the inflationary pressures, and of course, number one, don't fight the Fed. The flip side, though, is that it is record positioning. Pretty much every person we talk to is positioned for the markets to roll over. As we're seeing, just more recently, when the market doesn't do that, it can sort of flip up pretty aggressively.
And what stock did you want to talk about today?
I'm a little bit torn, actually, because most sectors we look at, we actually don't want to invest in right at the moment. We normally hold 55 to 65 stocks through the cycle, and we're on 42 stocks at the moment, which is the lowest we've had in a decade. So we're finding a lot of reasons not to hold stocks right at the moment. The stock I want to talk about today is really a tactical idea. So it's not structural, it's not thematical, it's more tactical, which means we sort of see a 6 to 12 month time frame on it. And it's Coronado Coal. I'm a little bit torn between that and Yancoal. They both are just generating enormous amounts of cash flow. I think Coronado Coal is probably the safer of the two.
And now most people watching this or listening to this will have some familiarity with coal markets, but for those that don't, maybe could you give us a brief outline of the different coal markets and what they're used for?
Yeah, look, simplistically, there's two categories. There's thermal or energy coal, and then there's metallurgical coal, which is where Coronado predominantly sits. 85% of what Coronado produces is metallurgical coal or met coal, 15% is thermal coal. So thermal coal markets at the moment, that's where we're using to generate electricity, and that's where we're seeing enormous demand, and that's where we actually see the opportunity, despite the fact that Coronado is a met coal stock.
And what are their assets?
Yeah, so they've got, in simplistic terms again, and this is what we like also, they've got 2 groupings of assets: Australia, basically current Queensland, and the US. And the nice thing about that is when we saw, for example, China's ban on Australian metallurgical coal, which is thawing to some degree at the moment, but at the height of that ban, they were able to still ship coal aggressively from the US into the Chinese met coal market and still capitalise on some of those record prices. So that geographical diversification is another factor that we like about the company.
And their first half of this calendar year was strong, but there was wet weather, there's some planned maintenance at Curragh and a lower coal price. Are you expecting those things to sort of rectify in the second half of this calendar year and for there to be sort of potentially bonanza results in the second half of this calendar year?
Yeah, I think you're spot on. I think, look, the first half was very, very strong. The dividend over 30 cents for the half with a special was extraordinary. And it's heading towards their record year, which is 2019. They paid 60 cents in dividends. But you're spot on there in terms of there was wet weather which impacted first half production. But also what people need to understand is that the coal price or the realised coal price they receive has about a 3-month lag. And you might remember back in the June quarter, the coal price, the met coal price briefly spiked at US 600 a tonne and sort of averaged probably 400 US a tonne for the quarter. So an extraordinary price. So they'll see the benefit of that flow through in this quarter along with record production. So they are setting up for a very, very strong half.
And we've seen a lot of things over the last, 5 to 10 years as investors that we thought were impossible. A lot of people thought were impossible. I think of negative interest rates, a negative oil price during COVID. And one thing that investors thought was impossible was that the met coal price could be lower than the thermal coal price because met coal is a higher grade, higher quality product. But that's what we've seen with the energy crisis in Europe for the time being, is the met coal price currently sitting below the thermal price. Maybe just walk us through that dynamic and whether or not a company like Coronado can actually sell some of their met coal for energy purposes.
Yeah, and I think that you're absolutely spot on. That's the real opportunity here. Apart from the fact they've got production improving and coal pricing coming through from the last quarter, I think the real opportunity there is a bit of a transition. So in 28 years of investing, I've never seen the met coal price trade below the thermal coal price. And what we're seeing now is not only is it trading below, but the thermal coal price out of Newcastle for 6,000 calorific value coal is 400 to 450 US a tonne, give or take, on any given day. And the met coal price is 300 US a tonne or less. So there's this huge differential there. Over time, we think that has to normalise. Over time, we will see some substitution. We're going to see some of the volumes in the lower quality met coal market, so some of the semi-soft and some of the PCI, pulverised coal injection product, we'll see some of that head into thermal coal markets. It's not as straightforward as just throwing it in the furnace. That there needs to be some adjustments. But if we see even 10% of the production out of met coal move to thermal markets, you're going to see a pronounced deficit in the met coal market. So over time, we see the thermal coal price will retrace, will come back, and we see that the met coal price will rally from here.
And so in terms of energy markets, I think most investors are wildly bullish really for the foreseeable future, given the issues with Nord Stream we've seen and all sorts of other issues in the short term over in Europe post the Russia-Ukraine conflict. But one area where investors are generally pretty nervous is the Chinese property market. How are you viewing that, and how are you getting comfortable with the world's need for steel in a Chinese property market that appears to be cooling off at best and at worst crashing?
Yeah, I think you touched on two things here. I think firstly it's worth touching on the structural change we're seeing in the European energy market. Like, we have literally had a line drawn in the sand. The war in Ukraine could end tomorrow, but Europe is not going to return to the level of dependency on energy that we've seen over the past couple of decades. So we have seen a line in the sand. LNG will be the medium-term fix there. That's going to take 2 to 3 years to bring on the LNG volumes and the import terminals and the pipelines, etc., to meet that requirement. So the next sort of 2 or so years, coal is the only solution that meets their energy emergency. And we're seeing a whole variety of old plants coming out of that have been mothballed coming back into production to meet the short-term crisis. So as I said, it's a tactical idea for us. We've got a 6 to 12-month timestamp on it, and then would look to reverse this position. So I think that's the first thing to look at, is that there is this structural change in the energy transition market. In terms of Chinese property market, look, we are cautious on that. For over a decade now, we've known that there's been some unsustainable practices there. And also the COVID lockdowns, which aren't getting a lot of airtime at the moment. But as we sit here today, China is still fixated on locking down large swaths of its population as a way of trying to handle COVID. And that's not sustainable. They need to evolve from that. What we've seen in the past is whenever China gets into a crisis is that they throw a lot of money into infrastructure, into the property markets to stimulate the economy. We're seeing now that's not having the same sort of leverage. So it won't be the go-to play as much as in the past. They won't look to, as major infrastructure build and major property projects to try and stimulate the economy. It's having less of an effect there now. But nonetheless, it'll still be part of the mix. And, I think over time, people are failing to appreciate the industrialisation that's happening in other parts of Southeast Asia and also, of course, in India. And China will still produce an enormous amount of that steel, but they'll increasingly export that steel into those markets, particularly into Southeast Asia, or we'll see those markets develop their own steelworks over time, which will continue to absorb met coal. So, in summary, we're not bullish on that space. We think there is some slippage there. But we think the transition into thermal coal will outweigh any slippage we see in met coal demand.
And all over financial Twitter or financial media, there's plenty of people talking about a global recession that's potentially looming. Broadly in commodity markets, how are you feeling about the lead into or the effect on commodity prices a global recession would have, given the lead in, particularly in capex, in particularly naughty commodities, for want of a better word, in oil and coal, compared to the last commodity super cycle we had leading into China, where capex and investment was significantly higher?
Yeah, you touched on two really important aspects there, the demand side of the equation, the supply side of the equation. Look at the demand side first. There's no doubt that, a recession is negative for demand. We saw initially there was a focus on inflation, which was great for commodities, so commodity prices rallied, but then the rhetoric very quickly transitioned from inflation to recession, and recession, of course, is bad for commodity prices. Just as a simple sort of rough guide, if you look back at the March 2020 COVID event, that had about a 10% impact on demand for commodities, so very large. The typical recession has somewhere around about 2, 3, 4% impact on demand from past recessions. There's no doubt we are probably technically already in a recession in the US and probably other countries as well. There's no doubt that we will head into recession, globally. So I think that's a given there. So I think that does impact the short-term demand for these commodities, and that's why we're very specific about the commodities we're targeting. We're targeting two types: energy, because of the crisis in Europe, and then secondly, those that are focused on EV. So our iron ore exposure at the moment is the lowest it's been, I think, in the past decade, as an example, and we could say the same for a lot of other commodities there. On the supply side, I think you've touched on something that's really important, but it doesn't impact short-term movements. It impacts the medium to longer-term outlook. There has been a record underinvestment in commodities and commodity projects over the last 15 years. We've seen record levels of fiscal discipline from the majors in terms of giving money back to shareholders as opposed to buying projects at the top of the cycle. I think people also have to understand too that $1 billion invested in a project today has much less impact in terms of new production as $1 billion invested 10 years ago, A, because of cost inflation, and B, because the fact that projects are much, much lower grade. The average copper project is about 0.4 to 0.5% copper grade now, as opposed to over 1%, 15 years ago. So for all these reasons, I think, the outlook for commodities over the medium to longer term is very good, but the supply side doesn't have a huge impact on the short-term outlook.
You've only got to look at the capital management initiatives of the other coal players. You look at the buybacks Whitehaven are doing, Terracom spinning out huge dividends, New Hope Coal as well. The supply response, it's not coming from them, is it? I mean, a lot of those guys aren't even interested in developing their own projects, let alone bringing on, buying new projects to bring online, because right now their equity is just so cheap. They're preferring to just buy that or give the money straight back to investors.
Yeah, spot on. I mean, Whitehaven doing a 10% buyback and then getting shareholder approval for another 25% buyback. I mean, that's extraordinary. That's over a third of the capital of the company they're looking to buy back and cancel. So you're spot on there. I mean, the approval process now is so difficult and so challenging in most industrialised nations for new coal projects. New Hope, for example, has been fighting over 10 years to get an existing project extended. You look at something like Yancoal, I mean, it hasn't developed a single new project, it's simply bought the Rio assets. Stanmore bought BHP's assets. So, there's no new projects coming on stream, and we're seeing that, in another commodity, for example, in gas, where we're seeing this huge, tightness in the market there. And it's not because there's a shortage of gas reserves or resources, it's simply the lead time to develop a project. They say now that for the average commodity from first discovery to first production is 13 years. Once you get through the approval process, financing, and construction. So, you can see that the outlook, the medium-term outlook for commodities is very good. But as I said, short-term, we've got this recession on the horizon.
And just to finish up, talk me through the numbers. So for calendar year 22 numbers, what's their market cap currently? What do you think they can do EBIT-wise? And maybe what sort of dividends can you see them paying out?
Yeah, so it's a really good question to focus on market cap there, because their market cap is just under 3 billion, and they're producing the same amount of coal as Whitehaven with a market cap of 9 billion, but they're producing met coal as opposed to thermal coal, which is the much higher margin product over time. So this is where we do see some danger in some of the thermal coal producers, because over time we do expect the thermal coal price to come back sub-US $100 a tonne. From the 400 mark now. So there is a lot of danger in those producers over time. There's a lot more stability in something like a Coronado, because over time we expect the met coal price to average US 180 or thereabouts, maybe a bit higher now over the longer term there. So we sort of see that, on the current metrics, we expect they're on about a P of 2.2 to 2.3 times. We're slightly under consensus, so our model's slightly pointier. We see that they can generate free cash flows. That's after all sustaining capex, after tax, after everything. Free cash flow of about 72% over the next 2 years. So that means they're going to generate 72% of their market capitalisation in free cash over the next 2 years. So you can get a lot wrong post that and still make very good money from here. We think dividends will be highly variable depending on how the coal price maps out over the next sort of 6 to 9 months. But we do think they'll probably surpass their record dividend, which was 60 cents in calendar year 2019. And we think the outlook is, for around about between 55 and 60% in dividends over the next 2 years again. So, as I said, there's no doubt that it's a cyclical play. There's no doubt that it comes back from here. But we think we generate so much cash and so much, the returns are going to be so high, it'll justify any reduction in the share price in the coming years.
Romano, it's a brilliant outline of Coronado. Mate, thanks very much for coming back on the show. Really appreciate it.
Yeah, anytime. Thanks, Chris. Thanks for having us.
This episode of Talk Your Book was proudly brought to you by Honan, who go beyond a transactional insurance broker to deliver better outcomes for their clients. If you're enjoying Talk Your Book, make sure you subscribe to Chris Judd Invest.